Godrej Consumer Products has reported its Q4 earnings and a very decent set of numbers, except for a surprise net loss due to a one-time exceptional loss of around 2,300 crore in the Africa, USA and Middle East region. I'm joined by Aasif Malbari, the CFO of the company, to discuss the earnings of the quarter gone by and, more importantly, the outlook as well. Thank you so much, sir, for taking the time. Could you help us understand a little better on the loss front?
Sure. So thank you for having me on your show. Just to clarify, this is a loss which is impairment loss. We looked at it's an accounting loss. We looked at our carrying values. We kind of did a write down. It's a one-time loss. It's not really a cash loss from that point of view. The entire East Africa reorganization, which we completed in the last quarter, is cash positive to the company. It's actually brought in around 200 to 300 crores cash to the company, and hence it's kind of puts us in a much more stronger wicket going forward.
Okay, but if I look at your revenue numbers, you did allude to subdued trends in your quarterly update, but yet you have posted better growth than your peers. The India business have grown quite handsomely. Where do you see this headed?
Sure. So I think this is the fourth quarter where we declared very strong high single-digit underlying volume growth. And with this quarter, our overall underlying volume growth at a total console level was 9%. It was very broad-based. We declared a 7% underlying volume growth in India, a 12% underlying volume growth in Indonesia. Africa was a 10% underlying volume growth, and LATAM was also very strong growth. So a broad-based growth across all clusters in this quarter. And coming specifically to India, both the business which was our existing brands and the acquired business both delivered strong growths, which took the overall growth to close to 15% on volumes. On deodorants and male wellness, we delivered actually a year-on-year growth of 25% and did a total of 137 crores. So the first few months did go into optimizing SKUs, consolidating the business, but this quarter has been a good quarter from that point of view because most of the actions in terms of synergizing the business with GCPL are now behind us. The synergy has also given us a huge margin improvement. We would have saved around double digit in terms of the cost base which we were able to kind of reduce on the business which we acquired. So we're quite happy with the way we've been able to integrate and save, and growths have started to kind of now come into this business.
Right, I have the numbers with me. So the Raymond's Consumer Care did a strong 137 crore in a seasonally weak quarter, and I think it grew 22% year on year. So is this quarterly run rate is sustainable going forward for this portfolio?
Yeah. So again, this is a business which has a lot of seasonality, but from a growth point of view, we definitely see many quarters and I would say many years of strong growth on the acquired portfolio. It will see double-digit growths for multiple years to come, and we are quite confident that the growth of the acquired portfolio should be significantly more than the overall FMCG growth. So yeah, we remain optimistic on the acquisition.
All right. Coming to your consolidated numbers, the sales growth continue to lag behind volumes. So could you tell us if this is something that you would like to see a reversal, or would you see this trend continuing in the upcoming quarters?
So, there have been commodity deflations, prices have been going down, and we've done the right things in terms of passing on the benefits of lower commodity prices to the consumers, keeping the focus onto ensuring that we get strong volume growths and we increase the consumer franchisee. But as we speak, there has been mild inflation, which is kind of coming back in the industry. Last 2-3 months, we saw increase in palm oil prices. We are seeing increase in the overall cost base. Even non-material costs have been going up. So there is an increase in prices which is happening around the board. From a next year perspective, definitely we will see price growth ahead of volume growth more in the second half. So there could be a quarter or two where there could be mild deflationary impact because it takes time to catch up. But for an overall year perspective, and definitely for second half, we will see sales growth being ahead of volume growth.
So, is it right to assume that in the second half of the year you will be considering price hikes, and if any range that you would like to indicate?
So we've already started taking mild price increases. In the month of April also, we took price increases on the soap portfolio because of increase in palm oil. And we will see the impact of some of the cost reduction, the price reductions which we took actually kind of coming into the base. So we will see in second half, overall reported growths on sales being higher than volumes. It's also when you look at consolidated business, we have seen a lot of commodity, we've seen a lot of forex impacts last year. So we saw the Naira getting devalued, we saw the Argentinian peso getting devalued. All of those are going to take a couple of quarters to kind of anniversarize, after which, if you see at a consolidated level, sales growth kind of go ahead of volume growth. So yeah, we just need to wait for it to anniversarize.
All right, I was actually about to ask you about the currency headwinds. Also, can you throw some light on the Indonesia business and the rest of the overseas market, how the performance has been, and how do you see it shaping up in this fiscal?
The Indonesia business actually has had a fabulous year. It delivered close to 12% underlying volume growth in last quarter and an 11% volume growth in the entire last year. Our mixes are looking strong. We've taken a lot of intervention in terms of strengthening the shape of the business through structural projects. So we remain quite positive in terms of the outlook in terms of growth in Indonesia. When it comes to the Africa and the Latin America business, our focus has been to kind of go for profitable growth. And hence, we are definitely looking at multiple ways of structurally improving the profitability of those businesses. Some piece of the actions which we took in last quarter in terms of reorganizing the business, moving it out of GCPL and putting it to another entity to kind of run it and get a charge back and taking a kind of non-cash charge on the P&L are all actions towards building a profitable business. So we are quite confident that, the profit growth in those geographies should be significant in the quarters and years to come.
All right. So you did mention about the company that is working to simplify business, to strengthen EBITDA margin is what I believe. So, where have you come so far on this, and what is your margin guidance for FY25 if you would like to throw some light on that? And also, do you expect the EBITDA growth to grow ahead of your volumes?
Sure. So we have significantly stepped up our EBITDA margin over the last couple of quarters. Having said that, the step up has been after making significant investments in the brands. While we've stepped up EBITDAs, we have also significantly stepped up our investments in advertising and hence ensured that our brand salience and relevances are at an all-time high. A lot of the improvement in margins has come in through reduction in the cost base and getting the leverage in the business. So we do believe that, and also through improvement in mix, we've seen higher growth in categories which are higher margin and higher growth in countries and sales which are higher margin. So we do believe that we should be able to sustain these margins and improve from here. So definitely the focus going forward next year also will be to ensure that EBITDA growths are higher than the underlying volume growths. We will look at expansion of margins from that point of view.
Okay, and any guidance on the margin front, like any range that you have in mind?
Yeah, so we will definitely look at double-digit growth in margins. That's something which we definitely will be aspiring to deliver next year also.
Okay, coming to the segment-wise growth, could you tell us how the home care business has performed?
So the home care business, at a structural level has done well. Liquids, all our three brands are well placed and done well. Fab was well received by consumers in the states in which we launched it. In terms of household insecticides, we had launched in last quarter the Goodnight Agarbattis. That was very well received by the market, and we are seeing repeat buying kind of coming in as we speak.
Right.
The overall, I would say, climatic conditions in terms of a shortened winter and delayed winter was not, I would say, very conducive to what one would have seen from a home care demand point of view. But we see that as a temporary piece, and with all the actions which we've taken as a company and some of the plans which we have, we remain quite positive, bullish about the demand environment going forward on home care.
Okay, but I have a very specific question in mind with regards to home care. Do you see that the liquids as a category is growing much faster than soaps, and this is largely aided by premiumization? Is that something that you see in your business?
Yes, we do definitely see liquids growing much faster, and that's the reason why we've kind of enhanced our portfolio to add Godrej Fab. In this, we also launching now in terms of synthol body foam. It's a very unique product where instead of body wash liquid, as you kind of press it, you get foam out of it, and that again is a beautiful product, and we're hoping that consumers will love it.
All right, wishing you all the best, and thank you so much for speaking to us at NDTV Profit.
Thank you for having me on the show.